In today's video, I'm going to be teaching you exactly how to enter a trade using the 15-minute time frame on gold. After watching this video, you will understand exactly how to enter a position on gold using a fixed set of confluences, which have allowed me to achieve over $100,000 in payouts alone using prop firms. Take notes and apply the strategy exactly as I explained, and you will be able to succeed. Now, make sure to take notes. Let's dive straight in. So we're going to start with the first piece of confluence, which is called market structure. And when we look at market structure, we just simply want to identify the overall trend. As you guys probably know, we have something called an uptrend where we make higher highs and higher lows, and we have something called a downtrend where we make lower lows and lower highs. Now, in this particular chart, we can very obviously see that we're trending to the upside. So we're making an uptrend where we have higher highs and where we have higher lows. So what we're going to be looking for are potential further longs, as when the market is trading upwards and in an uptrend, you only want to be buying and not particularly be selling. So what we have over here is a low. Here we have a high. Here we have a higher low. We have a higher high, higher low, higher high, higher low, and now we're obviously expecting a new higher high to be formed. Now, when the market is trading as aggressively as it has been here in towards the upside, all you want to be doing is simply buying when it comes down to market structure. So the very first confluence that we can write here is market structure, and our market structure is bullish. Now, there is one other form of market structure that I like to look at, because obviously this was the overall swing structure. So with swing structure, we just zoom out and we just see, okay, what is the bigger picture doing? Okay, it's very clear. We're trending overall in towards the upside. But if we want to trade the market itself and you want to form a daily bias, we also need to look at the individual candlesticks and look at something called fractal structure. So when we look at fractal structure, we look at the market structure of individual candlesticks. And what I can see is that when we look at the structure of individual candlesticks, is that this here is my low and that this here is my high, and that we saw a break of structure right over here. Now, what you can very clearly see is that we get that push up, we get the push down, we get the push up. We got a little push down here, by the way, with this wick coming back down in towards this overall area of demand. I'll touch upon that in a second. And then from there, boom, we just shoot straight back up. So overall, again, the momentum is very clear in towards the upside, and the overall, let's call it this way, daily fractal structure. So daily fractal structure is bullish as well. So overall, again, we're looking for longs when it comes to market structure. Now, the confluence point number 2 that we're going to be looking at is demand. Obviously, when we're trading in an uptrend, you always want to be identifying these potential areas of demand. And there are two very simple ways to identify a demand zone. Method number 1 is looking at so-called sell before a buy up. So we just look at what the sell before the buy up is, and then what you'll see more often than not is that here we have a sell, strong buy up, breaking the inner market structure, and the market comes in and then pushes back out again. Then again, we can just copy the zone. Then again, we draw it here on the sell before the buy. What happens? We see a sell down, buy up, market comes in and pushes back out again. And then once again, here we see a sell down before a strong buy up, market comes in and pushes back out again. Now, what we had most recently was this area of demand over here, where once again we had a sell before a strong buy up, market taps in and pushes back out again. So overall, the market was looking primed to continue further up higher, and therefore we are still looking for a potential long position, and we can therefore very clearly state that demand is currently in control. So demand is in control, market structure is bullish, and therefore we are still looking for potential further long positions. Now that we understand that demand is in control and that the overall market structure is bullish, I want to dive into the 4-hour time frame, because on the 4-hour time frame we want to pretty much see the exact same, where demand is in control. And what I'm going to do here on the 4-hour time frame is just remove a little bit of these lines just to make it nice and simple. Obviously, we understand that daily overall is bullish and that we're looking for further upside, but now we just want to see the same here on the 4-hour. So what we had here on the 4-hour was 1, a break of structure in towards the upside, and then 2, over here, once again, we had a break of structure in towards the upside. Now, when looking at an area of demand that is currently in control, we can then again identify here that we have a so-called sell before a strong buy up. So this is your aggressive sell in towards the downside before the strong buy up. So what I'm going to do here is again just draw down the confluences, or write down the confluences, where we have confluence number 1, which is called market structure. Again, market structure here is bullish. Right, so market structure is bullish. If we look at demand, we have demand in control. And if we look at confluence number 3 and confluence point number 4, we want to look at something else called 1, the PVD. So we look at the premium versus discount of the overall range that is currently in control. So this here is my range, where we have pretty much 0.5 fib here, which you at least pretty much want to see a retracement in towards. And then we have number 4, which is called liquidity. Now, what's very important to understand is that market structure, demand or supply, and liquidity, these are your must-haves. Okay, so you need to have these 3 confluences. The PVD is more just an indicator which is favorable to have as well, but is not a necessity or absolute must-have requirement. Okay, so we're going to be focusing on these 3 confluences here. And first of all, we can see, okay, demand here is in control. Market structure overall is bullish, right? We had the push up, we have the push down, we have the push up, push down, push up, push down. We're now just simply looking for another push up. And then when we look at liquidity, we can see here very clearly that we had an area of consolidation. We had a fake breakout in towards the upside, boom, a fake reversal in towards the downside. A lot of people looking for sells in what they thought here was a area of supply. So again, we had a fake area of supply here, buy up and then strong sell down. So a lot of people looking for another sell down again. However, obviously, if you zoom out and you understand that the market overall is bullish, it didn't make any sense at all to look for those potential sells from that area of supply. Therefore, we're focusing only on potential buys, but we can consider the liquidation of these lows over here a liquidation. Okay, so we call that liquidity, and that is the liquidity that we needed in order to fuel the next potential move up. So this is the 4-hour time frame, and then what we're going to do now is dive into the 1 hour and the 15-minute, where we're going to be trying to identify our potential setup. So we're going to be taking the setup itself here on the 15-minute time frame, because again, I've identified something very nice. Now, we understand that we have daily demand, and that we have 4-hour demand, that the daily is bullish and that the 4-hour is bullish, and that we have liquidity on the 4-hour as well. Now we're just going to simply apply the exact same confluences once again here on the 15-minute time frame on gold. Okay, so what we had here was 1, a break of structure in towards the highs. Therefore, remember the same confluences that we were just applying. We have market structure that is what? It is bullish. Okay, so the market structure is bullish overall. Then again, if we dive into confluence point number 2, we need an area of demand, and confluence point number 3 is liquidity. Okay, so do we have these confluences here on the chart? So I can straight away already see that we have liquidity. So liquidity is identified as in that we have an area of consolidation, and then what you often want to see is you want to see a liquidation of a low or of a high, and then you want to see a reversal in either direction. Okay, so here we have an area of consolidation. So what you want to do is you want to mark out the range low, which is pretty much positioned over here, and we want to mark out the range high, which is positioned over there. So this is the range high, this here is the range low, and what we're now looking for is a potential further buy in towards the upside after liquidating the range low, because at that point in time you'll have liquidity, and you'll also have market structure that is bullish, because this here is your swing low, right, and this here is your swing high. So we're looking for further upside, but we just need what? We need demand, and we need liquidity as well. So what we have here is a chart on the 15-minute time frame, and what we see now is that we have liquidation. So liquidation happens here. By the way, this is also considered an area of 50-minute demand. Again, you have what? You have a sell down before a buy up, right? So this here is your strong sell down before the buy up, which broke market structure over here. Therefore, I consider this an area of demand. Also, what you can do when trading liquidity, and with liquidity, I'm just referring to this significant low over here, you can also consider liquidity an area of demand, okay? That's also very important to understand, that which you can note down, because often you will see the market react to those areas of liquidity and then reverse in towards the upside. A good example could, let's say, be over here, where you have these two equal highs, and then what happens? The market was consolidating, it liquidates the range low over here, and then it liquidates the range high over here. Therefore, I consider those liquidity points also areas of supply or demand very often. So now what we have here is that we have the low liquidated. So again, we have market structure being bullish. We have an area of demand over here. We obviously spiked through it, but this is more just, again, kind of like a liquidity grab. Then we have also a sweep of the liquidity. So now what I'm looking for is what? The potential entry model. So we're now going to look for the entry model, and the entry model is very simple. The entry model is just based on actually exactly what we've just been explaining. We need a demand together with a market structure shift. Okay, so this is now what we're looking for. We need a demand zone with a market structure shift. So what we have here is on the 15-minute time frame a market structure shift, because what we can very clearly see is that the market comes down, pulls back, comes down, pulls back, comes down, grabs liquidity, taps into demand, and then boom, reverses back in towards the highs. So this here is called your market structure shift, where we see the push down, pull back, push down, boom, market structure shift, as we have a break of what? We have a break of this area of supply. Now with this break of this area of supply, this then becomes your demand that is now in control. So this is now my demand zone, which should push the market up higher, because remember, we have here the entry model, which is your demand zone and your market structure shift or shift. And what I'm now looking for is that upside continuation after the market structure shift happened. My stop loss is now placed safely underneath the lows. We're going to be placing the stop loss underneath the liquidation low here so that it's safe, because we don't expect liquidity again to be grabbed in towards the downside. And we have demand currently in control, which caused what? It caused a market structure shift with the break of this high over here. Now we're trading on the 15-minute time frame, and as you can see, we went from the daily all the way back down into the 15, and what you'll then see is that the trade plays out pretty well. What we had here was another area of demand then created again on the sell before the buy. So if you were to take a potential skill in position, you could have once again just simply bought on top of that new area of demand. Again, we're targeting the overall liquidity high. We then see gold continue in towards RTP. So this is how you can trade gold using the daily, the 4 hour, the 1 hour, the 15-minute. We looked at market structure, supply and demand, liquidity, and that is pretty much how you bring everything all together. So I hope you enjoyed this video. Make sure to leave a like and subscribe to the channel. And thank you for watching, and see you in the next one.